Hey everyone, welcome back to Lesson 7 of our FIA FA1 series. Today we're diving into an important topic, receivables, sales, and payables purchases ledgers. If you're new to accounting, don't worry, I'll break it down in a simple and easy to understand way. So grab your notes, get comfortable, and let's get started. All right, let's start with the general ledger, the backbone of a business's financial records. Think of it like a giant notebook where a business keeps track of all its financial transactions. Every dollar coming in and going out gets recorded here, organized into different categories like sales, expenses, assets, and liabilities. But here's the thing. The general ledger doesn't give us a detailed breakdown of individual customers or suppliers. Imagine running a business where hundreds of customers buy on credit. Wouldn't you need to know exactly how much each person owes you? Or, if you're purchasing supplies on credit, wouldn't you want a way to track exactly how much you owe to each supplier? That's where the Receivables Ledger and Payables Ledger come in. Receivables Ledger, Sales Ledger, tracks who owes you money, your credit customers. Payables Ledger, Purchases Ledger, tracks who you owe money to, your suppliers. Without these ledgers, businesses would be lost in a mess of numbers, trying to figure out who has paid, who still needs to pay, and how much they need to collect or settle. These ledgers make sure everything is organized, clear, and manageable, so no payments slip through the cracks. See? It's all about making life easier for businesses. Now let's break it down further and see exactly how these ledgers work. Let's go. Receivables Ledger, Sales Ledger, the business's personal tracker for credit customers. All right, let's zoom in on one of the most critical ledgers in accounting, the Receivables Ledger, also known as the Sales Ledger. Now imagine you own a business that sells products or services on credit. You let customers take their purchases today, and they promise to pay later. Sounds great, right? But here's the catch. How do you keep track of who owes you, how much they owe, and when they need to pay? This is exactly why we have the Receivables Ledger. What is the Receivables Ledger? The Receivables Ledger is a record of all individual customers who have bought on credit. It contains personal accounts for each customer, showing their outstanding balances and a detailed history of transactions. Think of it as a personal tracker for every single person or company that owes your business money. If the general ledger is the big picture, the receivables ledger is like zooming in with a magnifying glass, focusing on the details of each customer's financial activity with your business. Why do we keep a separate receivables ledger? You might be wondering, why not just track everything in the general ledger? Well, here's the thing. The general ledger is designed to give a summary of financial transactions. It shows how much money the business is owed in total, but it doesn't break it down customer by customer. Let's say your business has hundreds or even thousands of customers who buy on credit. If all of their transactions were dumped into the general ledger, it would become a chaotic mess, impossible to manage. So instead of crowding the general ledger with hundreds of customer details, we use a receivables ledger to keep track of individual customer accounts. This allows us to see exactly how much each customer owes at any given moment, track unpaid invoices and ensure customers pay on time, match customer payments to their debts so that we always know who has settled their accounts and who still needs to pay. Prevent credit limit issues. We can check if a customer is exceeding their credit limit before approving new sales. Why the receivables ledger is not part of the double entry system. Now, here's something interesting. The receivables ledger is not part of the business's official financial records. Wait, what? How can something so important not be part of the accounting system? Well, this is because the receivables ledger is just a reference tool, not an official part of the double entry system. Remember, Double entry accounting means that for every financial transaction, there is a debit and a credit recorded somewhere. But if we recorded customer transactions in both the receivables ledger and the general ledger, we'd be duplicating records, which would cause accounting errors. Instead, the general ledger keeps the total receivables balance, while the receivables ledger holds all the individual customer details. Think of it like this. The general ledger is like the total class grade a teacher keeps for all students combined. The receivables ledger is like each student's individual report card, showing their personal scores and progress. Why does the receivables ledger include only personal accounts? The receivables ledger consists only of personal accounts, meaning it only tracks real people or businesses who owe money. Why? Because when a business sells on credit, it's dealing with individual customers or companies, not general categories like income or expenses. For example, if John Smith buys on credit, his name goes into the receivables ledger. If XYZ Corporation buys on credit, their account is also recorded here. But we don't record general accounting categories here because this ledger is specifically for tracking who owes us money, not how much money the business has overall. The power of the receivables ledger. With the receivables ledger, businesses have total control over their credit sales. They can quickly check which customers are overdue, send reminders or statements to late payers, keep a clean, organized record of all outstanding debts, improve cash flow by making sure customers don't delay payments. So, while the general ledger tells us the total money owed, the receivables ledger tells us who owes us that money, which makes it an essential tool for any business that sells on credit. Pretty powerful, right? Payables Ledger, Purchases Ledger, the business's personal tracker for suppliers. All right, now that we've covered how businesses keep track of the money they are owed through the receivables ledger, let's flip the coin and talk about something just as important, the money the business itself owes. Every business, no matter how big or small, has to buy things to keep running. Whether it's raw materials, office supplies, rent, or professional services, most companies don't pay for everything upfront in cash. Instead, they buy on credit, meaning they receive the goods or services first and agree to pay for them later. Now, here's the challenge. Imagine your business has dozens, maybe even hundreds of suppliers. Each supplier has different payment terms, different due dates, and different invoice amounts. How do you keep track of who you owe, how much you owe, and when each payment is due? That's where the Payables Ledger, also known as the Purchases Ledger, comes in. What is the Payables Ledger? The Payables Ledger is a detailed record of every supplier or vendor that the business owes money to. It contains personal accounts for each supplier, tracking outstanding balances and all past transactions. Think of it as the business's to-pay list, a place where every bill and outstanding invoice from suppliers is recorded. While the Receivables Ledger tracks money coming into the business, the Payables Ledger tracks money going out. This ledger helps businesses answer critical questions like, how much do we owe in total? Which suppliers need to be paid this week or month? Have we missed any due payments? Are we staying within our budget for purchases? It's a lifesaver when managing business cash flow because keeping track of unpaid bills is just as important as collecting money from customers. Why do we keep a separate payables ledger? You might be thinking, why not just track everything in the general ledger? Wouldn't that be simpler? Well, not really. The general ledger is designed to provide a summary of all financial transactions. It tells the business how much it owes in total, but it doesn't break that amount down supplier by supplier. If every individual supplier account was listed in the general ledger, it would quickly become overwhelmed with unnecessary details, making it difficult to use for financial analysis and decision-making. Instead, businesses use the Payables Ledger as a separate, more detailed tracking system, making it easy to see exactly who the business owes money to, the due dates for different invoices, a history of all past payments and outstanding balances. This ensures that every supplier is paid on time, avoiding late fees or damage to business relationships. Why the Payables Ledger is not part of the double entry system. Here's something important to understand. Just like the Receivables Ledger, the Payables Ledger is not part of the official accounting records. It is only a memorandum reference ledger. Wait, what? How can something that tracks how much money the business owes not be an official record? Well, in accounting, every transaction is recorded in the double entry system, which means every financial movement is recorded with both a debit and a credit. If the Payables Ledger was part of the double entry system, each transaction would be recorded twice, once in the general ledger and again in the Payables Ledger. That would throw off the entire accounting system and create duplicate records. Instead, we do this. The general ledger records the total amount owed to all suppliers. The Payables Ledger breaks that total down into individual supplier accounts for reference. This way, the business gets the best of both worlds, an easy-to-read financial summary in the general ledger and a detailed breakdown of supplier debts in the Payables Ledger. Why does the Payables Ledger include only personal accounts? The Payables Ledger is exclusively for personal accounts, meaning it only tracks real people or companies the business owes money to. Why? Because when a business buys on credit, it doesn't owe money to a broad category like expenses or purchases. It owes money to specific suppliers who provided goods or services. For example, if a business orders office supplies on credit from ABC Office Supplies Limited, that supplier is recorded in the Payables Ledger. If a business purchases raw materials on credit from XYZ Manufacturing Co., that supplier is also recorded here. But we don't record general accounting categories like expenses in this ledger because it's strictly for tracking debts to suppliers. The power of the Payables Ledger. The Payables Ledger is not just about keeping records. It's a critical tool for managing cash flow and maintaining good supplier relationships. A business that doesn't keep track of its payables properly might forget to pay suppliers on time, damaging its reputation and leading to late fees, lose important supplier discounts for early payments, struggle with cash flow because it doesn't plan for upcoming payments. With a well-maintained Payables Ledger, a business can plan ahead for payments, ensuring there's enough cash available when bills are due, avoid late payment penalties, and maintain good relationships with suppliers. Take advantage of supplier discounts by making early payments when possible. Monitor purchasing activity to make sure the business isn't overspending. Final thoughts. So, while the general ledger tells us how much money the business owes in total, the Payables Ledger tells us who we owe that money to and when it's due. Without it, businesses would be lost, struggling to remember which suppliers to pay and when. But with it, payments stay organized, on time, and under control, keeping the business running smoothly and suppliers happy. And that, my friends, is the power of the Payables Ledger. All right, my amazing students, thank you so much for sticking with me till the end of this lesson. I truly appreciate your time, effort, and dedication to learning. I hope you found this lesson on receivables and payables ledgers helpful and easy to understand. If you enjoyed this session and it helped you, don't forget to hit that like button. It really supports the channel and lets me know you're finding value in these lessons. And if you haven't already, make sure to subscribe so you never miss an upcoming lesson. We have a lot more exciting and important topics ahead, and I'd love for you to be a part of this journey. Also, if you know someone who's learning accounting or preparing for FA1, Share this video with them. Knowledge grows when we spread it. And if you'd like to go the extra mile in supporting this channel, any form of support, whether through comments, shares, or other means, is truly appreciated. It helps keep this content coming to you. Thanks again for being here, and I'll see you in the next lesson. Happy learning and take care.